Thank you very much, Sean. Happy Saturday, everyone. It's so wonderful to have you. It is, what a week it was. It is something that I think I've been repeating myself every week since the 2022 started. And it is actually good and bad, obviously, for people who are investors. And sometimes it gets a little threatening to see, my God, how the volatility of markets affect them. On the other hand, if you're a trader and you have a hang on the markets, I think it's been pretty rewarding ride, I believe, and that's what the traders live on or live for. So this week, mentioned I wanted to add a couple, well, one more segment. We've been doing this screen of the week. I think I'm going to add, we've been doing one screen, the squeeze screen, but I want to add another screen so we could have two. Of course, we have earnings of the week. But as always, we look at the economy, the markets, emerging markets. This is a new one, the lesson of the week, the trade of the week, and the screen of the week. So you can see more and more emphasis becoming on the economy, how it's affecting the markets, the big picture. So let's start with the economy. The good things which are going on, obviously the growth of the economy, the initial jobless claims. And if you go back, like the slides a year ago, even 6-7 months ago, you see how far we've come. As a matter of fact, now, this is for the February 4th week, which came out on Thursday, for the jobless claims. We are actually ahead of 2019. That means there were less people filing for jobless claim, and the continuing jobless claims also lower than where it was in 2019. Also, retail sales, which came out for the week of February 5th, they were healthy and they were up again better than 2019. So it seems like, again, the COVID is becoming less of an issue at this moment. There are more opening of the economies. I know they're loosening the restrictions in LA. My son, again, we got an email that one of someone that he was in contact with had a COVID. This happened a couple of months ago. They wanted us to send a copy of all his vaccination. This time they said, oh, if he's doesn't have a fever, then it's okay. We just want to let you know. So there's this, again, loosening of the restrictions. Having said that, I just want to share this as far as what's happening with the households with actually the fatality rate. This is as of February 8th. And as you can see, it's interesting. We get a downturn and then something new happens. We get this upturn and then come downturn. It's almost, trending up, higher highs, and then we trending down, lower lows, and then we get head and shoulder and higher highs. And then now we broke the double bottom and now you're basing. So basically, this is good news. This is the lowest it's been. So we pray that it's just gonna continue. Hopefully it will allow more traveling and again, which is good for the hospitalities and the traveling in the leisure world. So in the meantime, this was just interesting. Found that, the homeschooling rates, just comparing from spring of 2020 to fall of 2020, see how far it just went up because of the, again, being virtual studying and schooling. Of course, the big news of last week from the economic point of view, not the geopolitical side, everybody was anticipating the CPI. And what happened was, it was even, once we look at the markets, you could see, although the markets were going up, when you look at Monday, Tuesday, Wednesday, it was on a lower volume. It was almost like standstill in some ways, just they wanted to see what's going to happen. And of course, the CPI came, and it was the record high in 40 years. And of course, there's been a talk of they changed the whole weighting, and in January of 2022, I appreciate Jean-Claude had shared that video. I encourage you to watch that video. And I think we've had a conversation in past classes how the governments can actually play with the numbers and imagine what happens in developing countries. And that's one of the things we have to be careful. But that's what it is. It is when things, when you're governing something and you're in power, you can control it. They say the numbers don't lie, or the statistic don't lie, but a statistician can. So the way we can use those numbers, we can just twist them and twitch them and make it more favorable. And that's what has happened with the weighting of of all the elements. From, again, the biggest one is the housing. Of course, we have the energy and the food. So these are the core ones. And of course, the cars, how the government tries to use it to see what is the best, most favorable. Also, you have to remember the social programs, which they based on CPI. So just imagine that if you have a large, let's say, aging economy, and which is, again, Western Europe is, and of course, United States is becoming, Japan, even China, it's a big, it's a big factor to make sure, that the inflation is not as high, because otherwise the whole distribution of these retirements, let's say Social Security benefits, are based on the inflation or CPI numbers. So the government has an incentive, and of course, it's the psychological part of everything else. And so this is no surprise that the CPI, in a sense, came at 0.6%. And I talked about last month, we thought it would be higher, which when you translate over 12 months, it was 7.5%, which was the highest, as I mentioned, 40 years. But the idea is, I think in the past we've talked about, when you have a loose money supply, and it started in February because of COVID, whatever the reason was, I mean, you cannot help it but to have this. And the concerns that we've had, and we've spoken about this, is up to not too long ago, the Fed was trying to convince us this is transitory. And I think that, again, it has made things even worse. So I'm just breaking the things down. The housing rents, which equal to actual rentals plus the rental value of, if you rented your house, was actually 0.5%. The energy was 0.9%, but this is the big one. Electricity was 4.2%. The food was 0.9%, and I'm sure you all can feel that. So in reality, the CPI actually has been up 4.5% on annual rate since the February of 2020. So it is not, we cannot come with the story, oh, we are comparing it to April of 2020, when the things are completely shut down, or May. We are past that. It's 2 years later. So this has legs. So that's important. Talking about Fed, and I will mention it again in our weekly upcoming trading ideas of the week. I think one of the things that it really basically made markets nervous, besides, of course, what was happening with Russia and Ukraine, was on Monday, the Fed has a closed door meeting. So usually they don't bode well when they have this. So that's why all of a sudden market got nervous. Are they going to come out an announcement and decide to do an emergency, let's say 50 basis points? So that's one of the reasons the market really reacted in the last 2 days of the week. So just be aware of it. So that's something going on Monday. So what's going on for the calendar? Of course, another thing made the markets nervous. The Friday, the FOMC member Bullard, he said, he see the possibility, he wouldn't mind having a 50 basis point. So the markets took it, again to the heart, and that was one thing. And he's speaking on Monday, so just keep that in mind. And then also these are important, the ZW, the economic sentiment is like our Michigan consumer sentiment, the same thing we have. Actually, it's a German indicator, and then now they applied it to the whole Europe. So just be aware of that. Then on Tuesday, we have the PPI. CPI is the consumers, PPI is the producers. So we want to see from the producer's point of view, what is going on as far as the inflation, and it's projected at 1.5%. And then you have the core. And then Wednesdays, there's a lot going on, of course, in Canada, but USA, we have the retail sales, and it's important about the activities. But this is another thing, just remember, 11 o'clock, this is Pacific Coast time, and it is the FOMC meeting minutes. If you recall, last month, the market reacted heavily. So just keep those in mind. And of course, if we're following Aussie dollar, and they have their employments numbers coming up. So that's for the economy. Just so there's few factors you want to remember. Obviously, you want to be aware of Monday, and then also Wednesday, the FOMC minutes. As far as the sentiment, again, this is really interesting. This is going to be all over. And I'm so glad, I really appreciate it. I mean, these are the best lessons. These times, it makes real traders. So I'm glad you're part of this cycle, what's going on. And we will, obviously discuss what's happening in Russia and Ukraine, and how the markets got affected. But look at the sentiments. It's just really interesting. This came on Wednesday before the inflation numbers and obviously the Russian situation. So basically what we have is the sentiment on the bullish side has pretty flat, stayed low. It's the bearish side that 2 weeks ago we were, everything was negative. And now it's been just going back to almost its average. And what is happening, majority of people were negative last week. They actually moved to the neutral. Really, they don't know what's going on. So they're sitting tight to see what's going to happen next. And obviously, it was waiting for the Fed. And then from the CNN fear and greed, we're still at 33. So still there's this concern. And this Citigroup panic euphoria, I mean, this has been interesting. It's been trending down, and we are at 0.20. We're still not in panic. So we still haven't had that that panic. So that's what we want to watch. So let's see what happened in the market. Things were going well. It's Monday, Tuesday, Wednesday, and then everything almost fell apart on Thursday and Friday. So for the week, majority of actually segments of the equity markets, they were down. So the Dow Jones and even the utilities, obviously, because of the bonds, and then we had the S&P 500 was down almost 2%. We look at NASDAQ was over 2%. The two places were positive were really the small caps, which they've been really broken down. But you will see that the Amex, which American Stock Exchange, which was bought up by the NYSE. Now, American Stock Exchange has a lot of mining stocks, or basically basic material. And you can see, and we will see on the review of what other markets did, they were up 3.71%. Now, the interesting thing is, while the markets, the majority were down, the advanced declining line was not as bad. Still, the advances were less than decliners, but the week started, and then, again, it goes back to some of the soldiers still were up. So, but you can see the new highs and new lows. It's just the new lows are getting larger and larger. So what happened to dollar? And dollar has been strong again, but it should have been much higher before what happened on Friday. So when the CPI number came, dollar should have been really going up because of the interest rates. The thought of we could have, I mean, according to Goldman Sachs, now we could have 7 increases. And as you know, on Friday, the 10-year note went, it was highest in 2 years, went over 2%. So, but the dollar really didn't move. It did move on Friday, and we will review that again because of geopolitical. The T bonds also, they were completely, in a sense, going almost a low 2-year low. And then they really reacted, obviously, on Friday. So in a nutshell, what is happening with these things, you can see the same. I mean, there's going to be a very similar story for all of these. Crude oil went to 93.10, the highest since, I believe, 2014. Inflation moved to 263. And gold, which has been really neutral, and we will review that, it was up nicely on Friday. So all of these, every one of these are basically are risk in this situation, risk off, when there's a nervousness, obviously, because of what happened, the thought of, again, what's going to happen with the Ukraine situation, which, by the way, it's, going to watch this weekend. President Biden and Putin are supposed to talk. Well, we'll see what happens. But all of these assets are the ones who were up, and money moved from this, NASDAQ and S&P, and went to safe havens. And that's why, even with all the talk of inflation, higher interest rates, the bonds actually did go up nicely, because there is a fear. And that fear is looking for comfort. And they found it in dollar, they found it in gold, they found it in treasuries. And of course, crude oil is more of an economic reaction. So I think every week I like to share this with you, because it's playing more and more role in what is happening in the equity market. So this is, again, the global short term. Look what is happening to the short term rates. And you can see, obviously, we know what happened with the British Bank of England, and they increased their rates. And so it's been continuing. And the global long-term rates, you can see from 10-year notes to UK gilts and German bunds. Finally, German bunds are out of negative, they're in positive. And the treasury yield curve, you want to watch this. So you want to make sure you're aware of knowing that we are not in this environment, which was a year ago exactly, nice steep upward. And only a month ago, this is how actually the yield curve looked. This is as of Friday. And you can see from 5-year to 10-year, still upward trending, but you can see the flattening, and that's a concern. You see the steepness from 6 months to 2-year, and then from 5-year to 30-year. And that's what the markets are watching. And also the LIBOR, which we discussed last week, it's been just, which is a very big factor, again, for a lot of banks and institutions, and a lot of short-term lending, and even adjustable rate mortgages, things. That's important. It's the largest index in the sense that the markets follow. And then watching the spread between the corporate and the high yield bonds. So we want to be aware of that. This I've shared with you, I think, for the last 2 years. And we want to visit this again, because this is a monthly 10-year treasury note interest rates. It goes back to 1982, and that's the highest we had. We had Chairman Volcker, head of the central bank. Then we had a high inflation, and he wanted to combat it, and that's what happened. They increased the rates, and then what you can see, the trend line, and we go back, we hit it at 2018. We had a big, that's when Chairman Powell started, and that's a trend line, and also have a trend line going back to 1995. So one of the things I have also looked at, you can see these are the supports initially we've had at 2%. So I've drawn the 2%, in August of 2020, I believe we hit like 0.5%. But you see how that 2% has become a huge number. And I think the markets, I've said it before, they could live at that 2. Once we break that 2, going to 2.5, for instance, that's going to be very difficult because although there's a lot of cash in the companies, there's still cash in the individuals. That 2.5 can break a lot of unhealthy consequences. So the 2, we hit that 2. It's interesting. On Thursday, we went to 2.03, I believe, and then we came back down on Friday, of course, because of geopolitical side, but it was resistance. So let's watch that carefully. So let's talk about S&P futures, and let's see what happens from looking at the from Fibonacci. And it's just amazing. I mean, this is again, whether algos follow or whatever it is, the charts really give you a lot of clues. So this is from the high of December. You remember the Christmas, Santa Claus rally, to the low that we had in January, end of January. And look where we went back, the retracement. We were in this ambush zone, 50%, 61.8. We hit it once, got rejected, came below 50%, we stayed around, went back again, rejected that day. We tried again on Thursday. So before the CPI number, I mean, it was like the markets were actually gone up and then they just collapsed. So you can see we could not break that 61.8. And we could not break that 50-day moving average. We went up that one day and then we got rejected. And again, that's one of the reasons I like to have 2-bar confirmations. And what happens the next day? Of course, the story of Ukraine comes, and of course the FOMC. Again, the FOMC member Bullard comes, and then there's a Monday emergency rumor going on. So here we are. So we basically had like 3 or 4 rejections, and now we are below the 38.2. If you don't hold that, then your next will be, in the 43,500 area. Another thing I want to mention to you, I've said it before, we've really been ranging. Initially, it was 4,800 to 4,500 area, and the markets were in the range bound. They like that. And then once they broke it, there was a 300 width, and then they lost 300 points, went to 4,200. They retraced back to that mid, again, almost the center, that 50%, retraced back and now got rejected. So the markets like to go back to their mean, but then, again, there had been a lot of damages. I've said it, I think in the past, when you have these large bars, this, and then we compare it to this is not healthy. This is a market of nervousness and indecision. When we look at it, it's just keep what we talked about Fibonacci, now bring it back on SPX cash. Look what we did with the 100-day moving average. Again, first time got rejected, second time on Wednesday we went to 100-day moving average and again rejected. And look at the double top here. Now the question is, if you look at again the height of this, will we go back? It almost go back to this area. So this is what the charts are telling us. We are overbought on SPX. The MACD is trying to cross. Unfortunately, NASDAQ is the weakest one. When we look at this, NASDAQ went to the resistance. We didn't even come close to 100-day moving average. Looks like a double top, hit that resistance from many, many months ago. And the other thing is visually, if I look at this, as far as SPX, you can see from there to here, we covered 50, halfway. But when you look at NASDAQ, I mean, that's a lot of damage. I think we only recovered maybe 1/3. So there's a lot of nervousness. And of course, we actually did break the halfway line. We went up and now the momentum just turned down again. As far as the Russell, look at Russell was in November, mid-November, the second week of November, hit the highs. And from there to here, probably retrace maybe 20% of it. So very weak, although we are, again, this week we had a nice rally compared to other ones. We are overbought and we barely sitting above the 18-day moving average, and we hit the Bollinger Band. So keep that in mind. On the other hand, I want to look at on a weekly basis. Why did we have this bounce? And this might explain it, that 2 weeks ago, we actually, that week, we went hit the 100-week moving average, as well as we were outside the Bollinger Band. So this is more of a technical bounce right now. So it might, once we hit that, we'll see if it gets rejected and come back to touch that 100-week moving average again. And you can see there is no divergence on stochastics either. So, and the strongest really of all the indexes has been YM, because YM has really diverse, but a lot of, there's a financials in there, there's industrials, energy, so that's keeping it up. And of course we have some technology. So you see we actually broke above 100-day moving average. The 2-bar rule, we got rejected, went back up again, hit the Bollinger Band, got rejected, and we are overbought. So there's a lot of weaknesses going on all the indices. And transportation, the same story. In when we look at the Russell, it was giving us the heads up that we tried. That was a big day, and we got rejected, and we've been just weakening, and we've had the big drop. So we are way under 100-day, and we also below 18-day moving average. Now, on the other hand, VIX, you can see, we talked about last week, we hit our 100-day moving average and bounced back, and we broke above the 18-day. So that volatility, which comes, it gave us that VIX was giving us the hint, it's not willing to go below the 100-day moving average. The volatility is with us. The volatility, it doesn't want to go to 110 and below. So we're at 141. And then the 10-year yield, right? So we went, that was the highest we had been on Thursday. We went outside Bollinger Band, and then Friday happened, again, flight to safety, and although still embedded. So we want to watch that. So we'll see if it gets to overbought, then it will go to 18-day moving average. If it just turns around, then that's bad news. The same thing, you can see the 10-year note has been nicely under its 18-day moving average. Outside Bollinger Band, comes back in, it's still embedded on the other side. So the same thing with the 30-year bonds. They're a little stronger than 10-year, and we just became oversold. So we want to watch that closely. And the financials have been doing nicely. Well, they really got hit hard too. And once, I've said it before, technology being hit hard, if the financials get hit hard, really it's the energy stocks and some, perhaps the basic material, keeping the S&P up. So we want to watch this, because once this gets damaged, that's not going to be helpful. And the dollar, as I mentioned, the interest rates supposedly going up. There's going to be many increases. So dollar has not done anything. And yet, again, it was only because of geopolitical, and again, the protection, the money went to dollar, and we became oversold. On the other hand, you look at the euro. The euro has been doing, not hugging its 100-day, and the opposite of what the dollar did, and it's a drop. And gold. Gold gradually, it's been going up. Gold has been, you go back to this whole, I'm going back to since June. It's really been a really narrow range, and with the inflation and with the higher interest rates, obviously higher interest rates are not for gold, but inflation should have helped, although it's not a really, we should look at gold does the best when there's a really um, um, real yield is negative. That's the environment they strive, and we are getting, we are in that. But again, this reaction, as I said, with what's going on with inflation and other things, there are perception that, it would be a good place to be, but they should be around here. But anyway, Friday happens, and here we go. We had this big jump. Of course, we hit the Bollinger Band, got rejected. Now I will talk a little more about gold and the trade of the week for the setup. So we'll review that. Silver, the same reaction a little bit. They had a nice, after CPI number, they had a nice broke over the 18-day, and basically just hugging their 18-day. Copper had a really nice day on Thursday, and then came back to worry about the economic situation. And Bitcoin, that's another interesting thing. We'll talk about Bitcoin a little later, but you see, it's just interesting. It goes and hits its Bollinger Band, and it cannot break it. And if it does, it usually comes back in. So right now, when the risk is, again, the risk was off, money is going to a safe place, is inflation. Well, Bitcoin was not a benefactor or beneficiary of that. And crude oil, of course. So these days, these 3 days, you can see we finally went under the $90. We were outside Bollinger Band. Technically, we came to our 18-day. Of course, there was the Iran issue. They want to do the talks. They think that they can start getting the sanctions lifted for the oil. And so there was a supply question. So the oil, went down. And then here, the geopolitical situation happens in one day. Whatever it was gone down goes up, and even more. And naturally, XLE has been just following what the crude oil has been doing. So let's, these expected moves are just unbelievable. I hope you have a good handle on this, because they really help your trading. And as you know, it's like 68% expected move. It's like your boundary 68% of the time. And we start with the SPX. What happened to SPX? We almost hit the upper edge of the expected move on Wednesday. That would have given you a heads up if you're playing probability game. Thursday, and what happened Friday? We just went and hit the lower edge of expected move and bounced back. NASDAQ, we hit the upper edge of the expected move. Of course, it was a lot more pressure. There was more sell-off, so we went outside of the expected move. By the way, let me go back to this. Our expected move last week was about 107. This week, you see, is wider. There's so much happening. It's going to be about 137, just for your information. So it's a wider band. And then IWM, it was strong. You can see we went outside, tried to stay outside, came back inside. The same thing with the YM, went on outside Wednesday, and we just respectfully got rejected and came back in. The bonds on the other side, they went outside the bone on the downside, and then they came inside the Bollinger Band. Gold was really respecting its its expected move. Look, and that was our, for Wednesday. I was watching this, and we will discuss again. Just remember this for our Thursday gold trade. So I'm watching this, and we'll talk about how I held my nose. And all you need is just one news, and here we see what happens to gold. That's why you want to diversify your portfolio, especially now. You want to have, if you have a long-term investments, you really want to have a multi-asset, because things like this happen in 1 day or 2 days. So the silver was all 4 days, actually. Monday hit the upper edge, and after that, just been staying above that. The financials, Wednesday, the same story. It's the upper edge of Bollinger, I mean, the expected move comes back in, and oil, I mean, the energy sector, they were steady. All right, so this is the new one this week. I think we spend maybe 5 minutes on what's going on in emerging markets. If you want to play it, you can. If not, I think my whole objective, and I will have a bit of mission statement, is I want to be as educated as possible and be confident and competent, and consequently you will become a very good trader, and consequently will be profitable. But that's the order. I mean, a lot of people, they want to be profitable first, and they make the money. Maybe if you talk to any meme stock and Reddit member last January, everybody was making money, most of them. But the idea is, if this is a lasting trading mentality, is this something? So the more we know, I don't want to go thin to go all over, but I want to go with depth. So I think it's important to understand and connect all the dots from the macroeconomy and how it gets affected. And I think, as I've mentioned, in the next 10 years, even 20 years, if you understand emerging markets, that's going to be a big added benefit to your portfolio. So let's start. This is just a little look. I start just on the surface. Let's look at Argentina's economy, which has been, Argentina was the 6th or 7th largest economy in early 1900. If you have visited Argentina, they have unbelievable architectures, a lot of European touch, from Germany to Italy to France. It's a beautiful country, but culturally something has happened to them. They've had so many political unrests. They've had hyperinflation, yet it's a very rich country, from food resources to energy. And this is what has happened as far as the reserves, you can see. And the reason I want to bring this International Money Fund is decided they're going to help Argentina this past week. So let's see what happens. And if you want to watch some of Argentinian stocks, especially Mel, which is an internet company, or Arco, which is Arcos is like a McDonald's of Argentina, and then they have YPF, and they have which is in the oil company. So watch that. But also we want to see, look what has happened with the inflation compared to the GDP. And this is what we want to be careful. Finally, hopefully the help is on its way. So they're going to keep that. But as of now, the projection is, it's flattening. So, and these are the regions in Argentina. You see the Buenos Aires, it's about 90,000 peso. So, compared to, for instance, the South. And there's not a lot of population, but there's a lot more wealth there. When you go to, these are more of a farming area. You go to Cordoba, there's a wining country, or the wine, not the wining, the wine country, and a lot of nice Melrose and nice wines here. But you can see the income goes much lower here. So that's a little bit of Argentina. The other thing is that I'm going to emphasize is we've had quite few interest rates decisions coming around emerging countries. I mentioned four actually: India, Thailand, Indonesia, and Russia. So I want to share that with you. So India actually left their 4% in their February meeting. Now, there is an inflation pressure in India, but they feel that the expansion of the economy is more important. So basically, in October, December, and now in February, they have left it at 4%. One of the common themes you will see in a lot of different central banks, especially in emerging markets, the idea is, yes, the inflation will go up this 2022, But the projection is for 2023 and more so in 2024, the inflation rates are going to come down. So that has been a common theme. So some of these banks, they're hesitant on increasing. On the other hand, some of them like Brazil and we see Russia and Mexico, they've been increasing all along. So now this is what happened with India. But the interesting thing I found out about India, and we've talked about the flow of funds, India had, this was the highest they've had since except in March of when we had the COVID, outflow of funds. You see it goes back to 2017, but it's been for a long time. So although their stock market has done well, I mean, last year they were very good and they've done well in the past 20 years internally, but externally there's some problems, and inflation, again, it's going to be an issue for India. So they got to watch that. The other thing is, again, I talked about projection. So the way they are thinking that the forecast for 2023 and then 2024 will be, they're talking about 5.4, it will go down to 5 and then eventually to 4.5%. So that's one of the reasons they want to keep the rates where it was. Thailand, the same thing. They kept it at a very low rate of 0.5%. Now, their objective is, again, they feel there will be a fragile economy because of inflation. But the good news is they feel that the COVID being more under control, and they will be able to export, and especially tourism is going to come back. And Thailand is one of my interesting plays. So this is something I would watch. So that's just food for thought, but you can see they have very low interest rates and they do a monthly. Indonesia, the same thing. Now, one of the things we have to, again, they feel that the economy is going to continue growing and the inflation will be coming down. One of the things was, though, their central bank target rate was about 2% for inflation, but now it's been ranging 2 to 4%. So they have to be really careful. So they have kept it at 3.5%. So, and the consensus was 3.5%. So basically, we shall see what happens. And that's what, again, a lot of them believe that they will be able to keep the rates, inflation rate will be under control. On the other hand, once we look at Russia, Russia just increased it. It was on Friday. They did it with 100 basis points, and they are at 9.5%. Of course, they have a high inflation rate. And as you can see, they went to 7.5 in October. December went to 8.5. And then in February, just on Friday, they went to 9.5. And the projection for March is about 10%. So under 10%. So you want to, again, it's important to see, sometimes we look at the economies around the world, again, continuously Russia's PE ratio is one of the lowest, but you got to take into account the premium risk that you have to pay for these countries. So basically, again, you can see the policymakers, whatever they do, is they believe 9 to 11% the key rate. But look, their initial estimate was 7.3 to 8.3. So, you know, and on the other hand, they're projecting that the inflation rate will go to 5.5 to 6%. So we shall see. The last but not least is the Mexican interest rates, and they actually increased it again. That was a 6 times, and every time they've done 50 basis points. So now they're at 6%. They did it on Thursday, and they are the 6 times in a row they have done that. So basically, you can see that we've at 5, 5.5, and 6. Completely different subjects. I want to look at some of the oil producing economies around the world. And obviously, when you look at Africa, from the population point of view, Nigeria is the largest, really, and they are the largest producer of crude oil. Unfortunately, because of many environmental reasons, but also they haven't been able to clean up, or they haven't been staying up to date with, again, with the ESG of their oil fields. One hand, they have, that's why I just look at sometimes we look at the numbers on standalone, and we look at the barrels. They used to have a lot of spills, which you can see in 2010 and 2011 and 2014. You say, oh my God, they lost 78 million barrel, 78,000 barrels were spilled, and obviously environmental, it was dangerous, but they lost that. But at that time, they were producing 2.2 million of barrels. Now it has gotten, it's been reduced to 23.5, 23.8, and say, oh my God, well, this is pretty good. They've been, taking care of their act. The problem is the production has been, so on a percentage basis, they haven't really improved a lot. So you want to look at both sides, but also be aware of that their production is low because of, again, a lot of these countries, again, there's a lot of pressure from the consumer economies to clean up their operations. The next thing I wanted to share with you is watch these indexes when there's like obviously the Morgan Stanley, the global composite index. We look at, there were 20 companies included. I just want to share this one, the Grab, which is the asset management company in Singapore. They got actually included, which is very important because now they are part of an index. And basically that brings a lot of liquidity. So whenever any funds invest in that index, they have to purchase the stock of, in this situation, Grab. So it was just watch for those. This is just a chart of Grab. You can see there wasn't a lot going on, but the average volume has been 17.5 million. And look what happened. Well, basically, it was a big day on Thursday once the news came, and it hits that 50-day moving average, and then Friday everything was sold off. It was down 7%. They had a nice jump for the week, though, still up 10%, 10.71%. So that's our emerging markets. I hope it's helpful. I hope it gives you a little more confidence to get used to things and get a little, exploration and do more research and be comfortable with that. All right, let's talk about the lesson of the week. Let's talk about the chart of the week. And we want to look at how S&P reacts relative to its real earnings yield. So at this time, the reason we want to look at our real earnings yield is at negative 5%. I mean, basically we're not negative 5, but what happens is the markets, when the yields that we are in on our real earnings yield, the markets actually go down negative 5% when we're below zero, close to zero. If we are between 0 and 1%, then they go up about 2.5%. When the actually earning yield, and that's what, again, this year, I think it's very important. And I talked to you about, look for the value growth stocks. And as far as the ideas, we talked about growth at a reasonable price, the GARP, and the price earning growth, the PEG. You want to watch that. And that's going to play, I believe, this year. So you see, when there's earning yield is more than 5%, the markets go up about 17, 18%. So this is not promising, at least at this time. And again, this is real earning yield, not just the earning yield. And we'll explain it, what it is. So earning yield is kind of opposite of, or actually it is opposite of PE. So when you look at the price earning, so you divide price by the earnings, and you might get 20 or 25. The earning yield is the opposite. It's actually the earnings divided by the price. So if the easiest way is if you have a stock which has a PE of 20, then if you inverse it, it will be a 5. So the earning yield will be 5%. Now, that's the earning yield, but the real earning yield, which is takes into account inflation, which is the real earnings less than inflation rate. And that's what is important now, because we've got accustomed to a very low inflation rate environment. So if you have 5%, let's say a P of 20 and 5% earning yield minus 2, you're still positive 3%. And that will give you, about 12, 13% return. But when you take that inflation into account, all of a sudden, if you have a 5% earning yield, and then you have a 5% inflation, you go down to 0. So talking about inflation, I mentioned this before, the highest inflation rate we had was in 1948 and 1980 at 14.6%, and the lowest we've had was between 1948 and 1949 at negative 3%. All right, that's first lesson. Second lesson, I want to just share with you, just again, because you went through it, when there's a geopolitical event, and this happened, and we are going to see it even more in our trade of the week, how the markets just dropped. At that moment, this is right after that end of the day, visually we look at and we say, okay, we see red, 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 all the equities, they're all down. These are the futures, the markets are down. And what is up? What could go up when there's a crisis? And you see, obviously, the first, we see VIX, and then crude oil, because it was really geopolitical. So in this situation, perhaps if it was something else, if it was Middle East, for instance, the oil will be affected. But if it has nothing to do with the energy sector, then it will not be as much affected as not. But in this situation, energy sector is important. So you see completely the oil, Brent, gasoline, heating oil, natural gas, everything was affected. So it all the green. The bonds, which were down actually, they went poof up. The fear, 10-year, 30-year, and even 5-year. Now, you see the longer term, the treasuries are more affected because there are a lot of institutions, they play that. So the money goes, a lot of sovereign funds. So that was affected. Gold, obviously, again, gold was affected, and silver. Now, platinum and copper were not, in a sense, because they're more economic sensitive. If there's going to be a long-term war, there's not going to be a lot of economic expansion. So they got affected. On the other hand, palladium has been in its own world, and basically it's been more of the demand, and it was more of a technical bounce. So, but copper and platinum got affected. The food area, again, especially wheat, and we've talked about Ukraine and Russian wheat, and of course the dollar, the Japanese yen, and Swiss franc. So these are risk off, in a sense that actually risk on. Basically, this is when risk on is when there's they don't care what the risk is on. When the risk, they're not willing to take the risk, it's the risk off. So basically, you can see we moved from risky assets to all the protective or more of a, again, an insurance in a sense for the assets. The second thing I want to share with you, we want to see how about some of the sectors. This is on Friday. You can see only one sector was up, was energy. And the biggest loser was the technology and consumer cyclicals. So also it gives you an idea where the money goes, the rotates if there's a case of a crisis. I also want to share with you my, my workspace, and basically you can see the FANG stocks, all the technologies, everything was red. And these are all the ones we talked about: the wheat, 10-year note to US, the soybean and the dollar and crude oil and corn and VIX and VIX. So everything gold. So they were exactly what we saw in Finviz, but except the energy sector and utilities as a, again, defensive sector, everything else almost was really down. Okay. All right, so that's a short and sweet. So let's spend some time with the trade of the week, because it was really interesting what happened on Friday. And I want to go back, talk about Thursday. But let's talk about Friday. My apologies for all these lines. It's just a lot of pivot points from the past week. So I keep them because they respect that. Like, for instance, you can see how we respected this pivot from last week. And this is, again, we respected that. So everything is going hunky-dory, and then the news comes and we had just a big sell-off. And after that, we didn't know what to do, actually, but we had the sell-off. So one thing we can look at is I was watching, the advanced decline line, and we are watching it, and it's Friday, they were positive, and then they started trending down. And once they broke the zero, which was around 10 o'clock, the whole, bet was off, and we had that big sell-off. So I want to watch these, because internals tell you that this is not time to buy that dip and say, oh, this is a good time at 10 o'clock, let's go and right around here, right? So we had a little bounce back, and then it just sold off. So the next thing I want to watch is the ticks, and these are my line ticks. You can see most of the day we spent below zero, and we went with 1,000, negative 1,000 a few times, and we hardly could spend time around above zero. So watch this as well. It gives you a little more confidence to be on the right side. You see, for the last hour or so, we were just flat in a sense. Just didn't have much direction. You can see the same thing with ADD, and you see we try to go up, and we've been just back and forth. That's one thing. The second thing I want to discuss is, this is from Thursday. This line was drawn from the previous day's high. This was our gap, and this was previous day close. We gapped down because the CPI number came, correct? So we gapped down right here, and very nicely, quickly, what we did, we went and closed that gap. We filled a half a gap at no time, and then we went and closed that gap. It coincided with the high of the previous day, and also it was that closed the gap. So one of the ways you can play, if you want to continue, after the close of the gap, you could do a Fibonacci retracement from the low to the high, or from the beginning to the high of the, where the gap was closed. In this case, both coincided, and follow that. And you can see what happened was, first we hit that 38.2%, we bounced back, then we went to that 50%. This is our 50% line, and we spent 3 bars on that. We bounced back, went to the 23.6, and we just played around, and finally the news came. And as far as this was with the FOMC, the Fed, and that what's going to happen, basically the fear of the higher interest rate. So we just broke down, and what did we do? We went back to, again, this is my pivot point, but we were sitting on that 61.8, and we just stayed in that ambush zone for 6 bars. and finally went to that 78.2, and then we broke all the way to that beginning of our journey. And then eventually we ended up going to that close to that 120, 127.2. So anyway, I hope this is helpful. This is what how I use. If you play the gap play after the gap play is fill, you can use the high of the day up to that time, or you could use the first hour. And that's how I can use, like you could have some trades this way. Okay. Let's talk about gold, because gold was very interesting. So I'm going to spend a little time on this, if you don't mind, and tell you what I was looking for our gold trade, right? This is as of Friday close. This is again my workspace on Ichimoku. So I'm looking at, so this is my Thursday. It says end of the day. This is Wednesday, and we come in, and I'm looking at Thursday. I see this big resistance here at 71.5. So that doesn't give me much confidence, because the way I look at it, I'm looking at, all right, if I'm going to buy at the money, let's say 171, and that 171 has 70 cents premium, what is my odds of going to 170, 170 by Friday's close? Not that I'm going to hold it, but the touch. Is there a chance that, let's say, it's going to go above this? And what is it? How much? And then on top of that, I have to really go a little bit higher if I want to make my 50 or 100%. So I didn't have much confidence, but I did hold my nose, but I did have positive things as well. I could have done 10 contracts also. And my reasoning was, if you look at, because we're playing short term, I'm looking at the daily, we are above the cloud. I'm looking at 60 minutes, we are above the cloud. On a 30 minutes, we were above the cloud. And on 10 minutes, what I was watching, and I'll show it later, is I went below and I wanted to see if we can come back and cross. So the big picture was giving me confidence that at least the bias is to the up. It's just the potential of moving was not in my favor, because I thought, again, there's a resistance here. So, you know, again, you're going to play the probabilities, right? So I waited, the market's open. So, by the way, this is the daily, so you can see exactly where we stand. So this 23.6 was from my Fibonacci, going from the low of end of September to the high of November. And, you know, we've been really respecting our 61.8. We had been in the ambush zone, and it went up past that 38. So very nicely, we went to that 23.6. So this was my idea, but also you can see we were above the trend line, we were above the standard line. So there's a positiveness. So I was okay to buy, but as I mentioned, it's the potential was not there for my 100%. So, you know, I could have made 20% anytime. So here, what I was waiting for, this area. So you can see even the clouds were up trending on the 10 minutes. So this is Thursday. It went up, and then it came back down. So I waited. So I missed this part. I didn't go in. I watched for the retracement, and I went in somewhere around 7 o'clock, somewhere around here. Once we broke the cloud, I was more confident to get in. And once we broke the standard line and trending line, then that was good. So I put my targets in, and you shall see how that worked out. On top of that, one of the other things I look at, again, if you do futures trading, this is one of my strategies that, you know, if you're bored and you can't do anything, these are really scalping. So I use for 1 minute chart on GC. This is for futures. So I look at LRC and I look at large volumes. So whenever I see a large volume, I watch that. I'm watching LRC. I look for fading it, or basically, I believe there's going to be a reversal. So for instance, we had this right around right here. So, and this was at 5:30. I didn't take that, by the way, I wasn't here, but I'm just sharing that with you, how you can play if you're going to play 1 minute. So this was when the CPI numbers came. So it's almost like our FOMC or even our NFP play, right? So there was this large volume. And then we went all the way up outside this LRC, and there was this large volume again. So I was just watching to see when are the large volumes coming in. So at 6:30, if I was smart enough in that sense, because we hit that LRC, that would have given me a pretty, at least more confidence to get in. I know one or two of you smarter than me, you got in right around here. And that was one of the reasons maybe you knew it or you didn't know, because the 1 minute was on LRC. And you can see how nice of a move that was. So I waited for the retracement. So by the way, this is a 100-minute bar. So I use both, and this is my 30. So I waited for my 30. Once it got here, and it coincided going outside the my Ichimoku cloud on 10 minutes, that's when I got in. I only did 5. Oops. I don't know what happens. Just bear with me. Huh. Hello. Okay. Sorry about that. I don't know what's going on. It should download. Guess the internet got a little tired. All right. Sorry about that. Okay. So here we are. This is a trade I took right around 7 o'clock. I bought the 70 at the money 171 call. I put my target. So you could see with that move, everything got hit nicely. I had my 100%. So I took a picture on Thursday. So this was my really runner, but I didn't think, I said, usually it happens the next day on Friday. If I get lucky, maybe in the opening, my 100% will be hit. So I kept one. You could see I had bought it at 73. Guess what happened on Thursday? I was down for the day. So, but I held it because that was okay. I was out of 4. This is what happened next day. So you see, even on Friday, when it opened, I was still down. And of course, the news comes, and I got out at 150. It was almost 100%. So I got out here, just hit my target. And of course, it went up another doubler to over $3.20. I mean, this would have been a 400% or something like that. But anyway, that's or 350% or whatever. So, but that's how it works. You get lucky sometimes. That's why I keep that one runner. And there was so much going on internally. I was happy I didn't even look at it. I just heard that I was filled. So that was my gold trade. I want to share you one more thing, because I discussed this on 2 weeks ago when we met. We had our personal meeting. I think I talked to maybe a couple of you, and my thought was about Bitcoin, and specifically, I talked about GBTC, the trust fund, right? It's almost like an ETF, but it's not really ETF. And my thought was that GBTC, it usually has a high premium, and that's one of the ways that people cannot buy it at an attractive price, because of that high premium. So basically what I saw was actually the GBTC Friday of that day that we were talking, it was at 19% discount. So what I thought, I had not played GBTC before. I looked at, this is 2 weeks ago, what Bitcoin did. It did go hit that 100 week and bounced back. So right around here, that's the Friday. So what I decided to do, I decided, again, there's no options. It's very liquid in that way, but there's enough volume. So, it's about 80 million. Um, so I just bought this, I just bought 200 shares at $25. And as always, I put my target in. So I was out of 20% at this price. I was out at 25%, or 50 shares were sold at 20% profit. So that was my trade. It's a stock trade. It hit, it was, again, based on two things: discount on GBTC and short-term bounce on the Bitcoin. ETF of the week. So this is another, we've talked about this once before, and I want to bring it to your attention. I believe I'm going to do a class sooner than later. The cannabis stocks were very hot in 2018. And then 2019, there was so much enthusiasm, thinking that in 2020, if a Democrat gets elected, things will happen. Anyway, between 2018 and 2019, there were big moves. I mean, Tilray could go to $60 or $100. The stocks they were just to the moon. And then, well, things don't work that way forever. So they came down to earth and below the earth. So, but I think if you're gonna be looking at some values, there's a lot of issues, challenges, and that's why I think it would be good. If you're interested, we will do a class. I would do another class with just a specialist, maybe even two people, one who is actually an owner of some of these farming and other things, some of the challenges that they have, and a company, for instance, who is, publicly traded. But I think it's not a bad idea to look at the cannabis segment, and there might be some interesting plays. So as far as the ETF, I just want to share this with you. Look, for the day, when the whole market was going down, they were up 1.12%. That's the MJ. I use MJ, there's 4 or 5 others, because it's the largest. Look, it's the oldest, it's the most liquid, it has 2.26 million. It has options on it. And for the week, it was up 9%. And one of the catalysts, by the way, I will discuss about that. So this is explanation of, they work on the cultivation, production, marketing, and distribution. So they look at all kinds of different areas of cannabis. There's so many different things about cannabis. It's not just one thing. There's have a different from medicinal, we look at it. Again, because they're not officially legal in the United States, that's the challenge they have. But they have a lot of other challenges. But anyway, so I thought to share that with you. Look at, obviously between the United States and Canada, that's the big portion of their holdings. And then I will talk to some of you familiar with Cronus, and this is interesting. So you have indirect investments. I'll just share this with you a little bit. So I will go into it more. So then if you'd like to, we can do a class on it. Some of these, like let's say STZ, it's a symbol, it's like the vodka and hard liquor company. They actually, looking at the drinks, they are indirectly related. Ultra and Philip Morris in the cigarette arena, they have relationships with these cannabis companies. So they are actually are British Americans. So they are in direct plays, even food companies. So, but the biggest ones, like a lot of people know, Aurora, Cronus, Tilray, and Canopy. So it's just interesting play. As I mentioned, they've been around since 2015. They have about 703 million under management. So, but they have, these are some other ones, the Cannabis, CNBS, YOLO, TOKE, bought X, BDX. I mean, the average volume for these is about 50 to 70,000 compared to 2 million, but there's a THCX. That's another fund that was not written here. So, I mean, just a food for thought, okay? So that's one, if you want to be contrarian and look at some other opportunities. The stock of the week, also, it's interesting enough, it's in the cannabis, and I was not purposely looking for it. It came based on unusual options volume. So it's kind of a trade of the week. This came on January 31st. I was looking at it. At that time, we talk about Canopy, which is symbol CGC, trading at $8.04. They had an earning coming up on February 9th. So I'm looking at it and I notice, wow, there is a big 7,410 volume, and the open interest was at 3,900. That was at 7.5. They also had a large open interest at 10. That was 18,000. So, and this was on an ask side. So basically, I mean, somebody was buying these, and I'm looking at it. So I see, well, there's a 4,000 on the put side open interest, but there wasn't a lot of volume. So I knew there wasn't like a spread or anything, but this really piqued my interest. So I knew there's going to be an earning coming up on February 9th. I look at the chart. We were really close to that was a low on the LRC. I'm looking at the market profile. You see, we were very low to the low end of the value play, and this was actually point of control, and so we are right at it right now. So basically what I did two plays, and this is a picture of where it is now. So it is at $9.22. So they really had a good earnings, and that's one of the reasons MJ was up, because it lifted the cannabis stocks. So basically what I did two things. Let me see if I have, oh yeah, I have the other two. So this is from one account. My whole idea was this was an earning play. So I did two strategies. One strategy was the implied volatility play. So I did a calendar on this. And again, don't have it here, but it was a large open interest on both of these. So the implied volatility was, it was actually 140% or so. And it went down after the earnings to 100. This is February 18th, and this is positions for March, and that was 87.66. So I did two things. Number one, I did a calendar. So I wanted to take advantage of the volatility crush, and I went with 10. We looked at the charts. The 10, what is the chances of hitting it by Friday and go over? It looked attractive. So I sold the 10, collected the premium, and I bought this 10 for the March to obviously protect this. And, obviously it was, I think I paid, so this was a calendar. I paid like 20 or 22 cents, and it's already up to like 45 cents or net and spread. So that was one play in one account. And basically that was my thought. It was just purely on a crush of volatility. The next thing I did in a different account is I actually felt that 10 in March, there was a large a large open interest. And so I did go ahead and bought, oh no, this is actually the February. So again, the same idea is the February 10th. I said, I'm gonna sell this. And I paid 12 cents, and it's at 21 cents yesterday. So I'm losing money on it, but only 5 contracts. So I'm losing 9 cents. So that's $45. Okay. I'm losing $45 on that. But one thing I did, I actually felt positive. This was done right before the earnings. So I was looking for that implied volatility crush right the next day. But I did go ahead right around here. It was 103, I think, at $1, let's say. I bought 5 contracts, but for 7.5. It was in the money for what? For March. So the odds were pretty good that, again, based on implied volatility, based on the open interest. I did this. Number one, I kind of protected my open interest, I mean, my February. I'm believing that February we will not hit the $10 next week. So I can hit that $60 if that, or $50 I will. And then what I will do is this one already went from $1.03, just the next, right after the earnings, hit that $1.90. And on Friday, where everything was going to Hell's Basket, it hit actually 230. And of course, we are back to that 187. So I'm almost doubled in this. So if I sold everything, I would lose, I think, $40 on this, and I would gain 400 on this. So this is just what this is. I'm buying 2 different months and 2 different strike prices. So I have the March 7.5 and February. I'm selling February 10th. So I'm playing the diagonal. And that was my play. So I just stock of the week. You can watch some of the basically cannabis stocks if you like. And this is food for thought. All right. Next 2 minutes. I apologize, I'm going over, but just want to share that with you. These are the squeezes on S&P 100. There are not many. These are the most positive ones. So, and they're pretty much, the setups are pretty good. So just the food for thought, there's only 8 of them. The second screen is, I wanted to share this Sizzle index scan. It was done at the end of the day. Sometimes when you do in the middle of the day, the numbers are all over. So basically I did this on Friday, for instance, and basically my setup is really easy. I look at the weeklies, I clear my scan, basically everything's cleared. So I look at, and I go to Stock Hacker, number 1, Stock Hacker to weeklies. From weeklies, I clear all the scans. From the, I choose the stocks, options, studies, from, basically I chose the stock and I chose Sizzle index. And on Sizzle index, during the day, I had minimum of 5 and there were like 18 of them. But by the time end of the day, there weren't many. So I changed it to 2.5. And I look at from the highest to lowest. One of the things I like the weeklies is because I just don't want the stocks, like SPX was the biggest one. You can see the Sizzle was at 4.955. And we also had VIX, which was at 3.162. So anytime there's a 0, that tells you there are indexes. I like to see what's going on. So that was our screen of the week. I added this. This is upcoming week, the biggest ones that they're coming this week as far as earning goes. But of course, we have this. So watch for NVIDIA. It's coming up. A lot of eyes on that. We got quite a few. Now, one thing was Affirm, for instance, came on their earnings. I believe it was Thursday. They were supposed to come after hours, and they, by mistake, they released it, I believe, at 11:40, and they were down. Oh my God, they've already been down big time, and they were down like 20-25% as soon as they released that. So they got punished. So Upstart is in the same business. These are the ones we talk about in emerging markets. It's Affirm works with Amazon. It's about pay now on installment 2 or 3 payments and have your goods delivered to you. So watch that. I would watch DraftKings, Roku, and Sunrun, Walmart. So these are quite a few still coming up if you want to play volatility is this. So again, we have Palantir, Shopify, Roblox, Upstart, we talked about Roku, DraftKings, Walmart, Airbnb, and of course, NVIDIA. All right, thank you so much for your patience, 97 slides. So I appreciate, I hope it was helpful, and I am ready for any questions or comments. Thank you so much. Let me see, I think I'm